I want to be honest with you about something before this video begins. The title of this video contains a provocation. If Benjamin Graham lived in 2026, he would buy this. People see a title like that and they expect a stock tip, they expect a ticker symbol, they expect the name of a company that a dead genius would have selected from the thousands available in the modern market, and they expect that knowing that name will somehow transfer the genius to them. I am not going to give you a ticker symbol, not because I am withholding something valuable, but because giving you a ticker symbol would be the most anti-Graham thing I could possibly do. Benjamin Graham never gave stock tips. What Benjamin Graham gave was a framework for thinking and a set of principles for finding value and a discipline for acting on that value without being swept away by the emotion of the crowd. And if you understand those principles completely and honestly, then you do not need me to tell you what Graham would buy. You can look at the market of 2026 and find it yourself. That is what this video is about. By the end of it, you will understand exactly how Graham's mind worked. You will understand how his principles apply to the specific conditions of the market right now. And you will be able to do what he did, which was not to receive answers from someone else, but to derive them independently from first principles. That is the only form of investment knowledge that actually protects you, who Benjamin Graham actually was, and why it matters in 2026. Most people who know the name Benjamin Graham know it because Warren Buffett mentions him. Buffett has described Graham as the second most influential person in his life after his own father, and he has attributed a significant portion of his investment philosophy directly to Graham's teaching. But I want to tell you something about Graham that gets lost in the Buffett Association. Graham developed his framework in the 1930s. He developed it after personally losing most of his money in the crash of 1929. He developed it not as an academic exercise, but as a direct response to the most traumatic financial event of the 20th century. He watched brilliant, educated, sophisticated men lose everything because they had no rational framework for distinguishing between price and value, and he spent the rest of his life building and refining the framework that would prevent that from ever happening again to anyone who was willing to learn it. The reason this matters in 2026 is not that the market of 2026 resembles the market of 1929 in its specific details. It does not. The reason it matters is that the human beings participating in the market of 2026 are made of exactly the same emotional material as the human beings who participated in the market of 1929. The greed is identical, the fear is identical, the desperate conviction in moments of euphoria that this time genuinely is different and that the normal rules of value no longer apply identical. And that means the framework Graham built to navigate that human nature is not a historical artifact. It is as urgently applicable today as it was the day he wrote it down. What Graham looked for and why most of 2026 would not interest him. Let me be direct about something that many people who invoke Graham's name prefer not to say. If Graham were alive today and looking at the broad market of 2026, most of what he saw would not interest him at all. Not because the businesses are bad, but because the prices being asked for many of them bear very little relationship to the value they are currently producing. For their owners, Graham was a deeply quantitative man. He wanted to pay less for a business than the business was demonstrably worth based on what it currently owned and what it currently earned. He was not opposed to paying for growth, but he was deeply suspicious of prices that were justified entirely by projections of future growth rather than the present reality of current earnings in an environment where significant portions of the market trade at price to earnings multiples that require decades of perfect execution to justify. Graham would be sitting very still. He would not be excited. He would not be anxious about missing out. He would be reading and waiting, and he would be looking in specific places that most investors in 2026 are not looking. because most investors in 2026 are looking where the excitement is, and Graham always looked where the excitement was not the four specific places Graham would be looking right now. Let me tell you exactly where Graham's framework would direct his attention in 2026. And I want to be clear that I am not telling you what to buy. I am telling you how to think about where to look and why. And then the research is yours to do. The first place Graham would look is among businesses that are financially strong but temporarily unpopular. This was the core of Graham's method, and it has a specific name. He called it buying a dollar for 50 cents. The idea is simple. Find businesses that have genuine financial strength, a solid balance sheet with more assets than liabilities, strong and consistent cash flows, and a long track record of surviving difficult conditions, and then wait for the market to become temporarily pessimistic about them for reasons that are real but not permanent. A business whose industry is facing a cyclical downturn, a business that had one difficult year after many good ones, a business in a sector that is simply out of fashion because investors are excited about something else in these situations. The market frequently prices the business as though the temporary difficulty is permanent. Graham knew it almost never is genuinely financially strong. Businesses with real competitive advantages have survived every downturn in history, and the investors who bought them at the prices their temporary unpopularity created earned extraordinary returns in 2026. There are sectors and categories of business that have been out of fashion for several years, while capital and attention flooded toward more exciting areas. Graham would be looking there not because unfashionable is automatically cheap, but because unfashionable combined with genuine financial strength and a price that reflects temporary pessimism rather than permanent decline, that is his target. The second place Graham would look is among small and mid-sized businesses that Wall Street does not cover. This is one of the most important structural advantages available to the individual investor in 2026, and almost no one uses it. The large investment banks and asset managers that dominate professional investing are not interested in small businesses. The amounts of money they manage are so large that investing in a small company moves the price before they have finished buying it, and the return, even if the investment works perfectly, does not meaningfully affect their overall performance, so they do not look. The result is that small and mid-sized publicly traded businesses are significantly less efficiently priced than large ones. There are genuinely excellent small businesses trading at prices that reflect neglect rather than fundamental weakness, simply because no one with significant analytical resources is paying attention to them. Graham spent a great deal of his career in this territory. He read financial statements of small, obscure companies that nobody on Wall Street was discussing, and he found dollar bills being sold for 50 cents because nobody was looking at them carefully enough to notice. In 2026, with commission-free trading and fractional shares and access to financial statements for any public company in 30 seconds on a phone, the individual investor has better access to this territory than at any point in history. The professional investor cannot use it because of the size of the capital they manage. The third place Graham would look is among businesses being sold below their net current asset value. This was Graham's most specific and most quantitative hunting ground, and it produced some of the most reliable returns of his entire career. Net current asset value is calculated by taking a company's current assets, cash receivables, and inventory, and subtracting all of the company's liabilities, both current and long-term. What remains is a conservative estimate of what the business would be worth if it simply stopped operating, sold its short-term assets, and paid off every one it owed. Graham looked for businesses trading below this number. Think about what that means. You are paying less for the stock than you would receive if the company simply liquidated its most conservative assets and closed its doors, the business itself, its employees, its products, its competitive position, its future earnings potential. You are getting all of that for free, or more precisely, you are getting all of that at a negative price because the market is valuing the ongoing business at less than the liquidation value of its short-term assets alone in the deep value markets of Graham's era. These opportunities were common in 2026. Genuine net current asset value bargains are rare in large markets, but they exist. They exist most often among small companies that are temporarily cash rich after an asset sale or restructuring, among companies in cyclically depressed industries where the market is assuming permanent decline, and among companies in geographic markets that receive less analytical attention than the major exchanges. Graham would be scanning for them systematically and patiently, not finding them every week, but finding them consistently enough over years to build a record. The fourth place Graham would look is exactly where everyone else is not looking. This sounds like a slogan, but it is not. It is a direct consequence of how markets work. Markets are most efficient where attention is concentrated, when millions of investors and thousands of analysts are all looking at the same businesses. The prices of those businesses tend to reflect all available information quickly and accurately. Mispricing still occurs even in heavily followed businesses, but it is less frequent and less extreme than in areas that receive less attention. Graham's structural advantage throughout his career came not primarily from being smarter than the analysts who covered the same companies he did. It came from looking at companies that nobody else was covering at all. In 2026, the businesses receiving the least analytical attention are not in technology or consumer brands or pharmaceutical innovation. They are in old economy industries that do not attract excitement. They are in international markets that receive less English language coverage. They are in sectors experiencing cyclical difficulty that have driven away the fair weather investors who were there during better times. Graham would be reading the financial statements of boring businesses in unglamorous industries with no social media presence and no analyst coverage, and some of those businesses would be extraordinary values hiding in plain sight. The two tests Graham applied to everything he considered buying regardless of where he was looking. Graham applied two specific tests before he would consider a purchase, and I want to give you these tests precisely because they are more useful than any specific investment idea. The first test was the financial strength test. Before Graham cared about price, he needed to know that the business could survive. He looked at the current ratio, the relationship between current assets and current liabilities, and he wanted it to be at least 2-to-1. Meaning the business had at least twice as many short-term assets as short-term obligations. He looked at long-term debt, and he wanted it to be modest relative to the equity of the business. A company drowning in debt is a company whose financial flexibility is compromised, and financial flexibility is what allows a business to survive the unexpected events that always eventually arrive. He looked at the earnings record and he wanted to see uninterrupted profitability over a meaningful period of time, not one spectacular year, but consistent earnings across at least 7 to 10 years, including through at least one period of economic difficulty. A business that passed this test was a business that had proved its ability to survive, and survival was Graham's first requirement before any question of price was even relevant. The second test was the price test after establishing that a business was financially strong. Graham wanted to know that he was not paying too much for it. His most famous criterion was a price-to-earnings ratio of no more than 15 times the average earnings of the last 3 years, combined with a price-to-book ratio of no more than 1.5. The product of these two ratios multiplied together should not exceed 22.5. This formula represented Graham's attempt to quantify a margin of safety into the purchase price itself. He was not looking for businesses that might grow rapidly and justify a high price through future performance. He was looking for businesses that were already cheap based on what they had already demonstrated they could earn. In 2026, applying these criteria strictly across the broad market would eliminate the vast majority of businesses available for purchase. That is not a problem with the criteria, that is information about the current market. It tells you that genuine Graham-style bargains require patience and selectivity and a willingness to look in places where most investors are not looking, and it tells you that the investor who applies these criteria seriously and waits for businesses that meet them will occasionally find opportunities that the impatient investor chasing popular names will never encounter. The one thing about 2026 that Graham would find genuinely extraordinary. I want to end with something that I believe Graham would find not discouraging, but genuinely remarkable about the conditions available to the individual investor in 2026. When Graham was building his framework, the information advantage belonged entirely to the professionals. Accessing financial statements required physical visits to libraries or company headquarters. Analysis required manual calculation, and the time and expertise to conduct it were effectively barriers that kept serious fundamental analysis within the walls of professional firms in 2026. Every financial statement of every publicly traded company in the world is available to any individual investor with a phone, and 30 seconds, the tools to analyze them are free. The ability to act on that analysis with no commission and no minimum investment amount is available to anyone. The structural barriers that once made genuine value investing the exclusive domain of professional firms have been completely eliminated. What remains is only the willingness to do the work, to actually read the statements, to actually apply the criteria, to actually sit still and wait for the price that the criteria require, and to resist the overwhelming pressure of the crowd, which in 2026 is louder and more accessible and more persuasive than at any point in the history of markets. Graham's framework has never been more available to the ordinary investor than it is right now, and the willingness to use it has never been more rare. That gap between availability and willingness is where the opportunity lives. It always has been. Your assignment here is what I want you to do this week. Pick one industry that you find genuinely boring, not an industry you dislike, not an industry you think is declining, but a genuinely boring, stable, unglamorous industry that produces something the world will continue needing regardless of technological change. Find 3 publicly traded companies in that industry. For each one, look up these 5 numbers for each of the last 5 years, current assets and current liabilities to calculate the current ratio, total long-term debt earnings per share each year, current stock price divided by average earnings over 3 years to calculate the price to earnings ratio, and book value per share compared to current price apply. Graham's test: does the current ratio exceed 2? Does the long-term debt look manageable? Is the earnings record consistent across 5 years? Does the price to earnings ratio fall at or below 15? The odds are high that none of the 3 companies pass all of these tests. That is fine. You have just done the work of understanding why genuine Graham bargains are rare and what you are actually looking for when you search for them. Do this exercise for 10 industries and 30 companies over the next month, and you will have built the foundation of a genuine value investing practice, not because you will necessarily find a perfect Graham stock, but because you will have developed the habit of looking at financial reality instead of financial stories. And that habit is worth more than any specific stock tip I could ever give you. The bottom line: if Benjamin Graham lived in 2026, he would not be excited by most of what he saw in the broad market. He would find prices high relative to demonstrated earnings in many of the most followed and discussed companies. He would find the crowd focused on future stories rather than present realities. He would find the financial media generating anxiety and activity in ways that serve everyone, except the long-term investor, and he would do what he always did. He would sit quietly in a room with a stack of financial statements. He would look where others were not looking. He would apply his criteria without exception and without compromise. He would wait with complete patience for the price that his analysis required. And when that price arrived, he would act decisively and without hesitation. That is what Graham would buy in 2026, not a specific stock, a specific process. And that process is available to you right now with no money, no connections, and no credentials required. Only the willingness to look at reality instead of stories. That is how the intelligent investor thinks. Thank you.